Well, good morning, everyone, and welcome to our presentation on the autumn 2020 budget. I know there are still a number of people who are still registering, but unlike a meeting at the in a hall somewhere, you don't have the embarrassment of walking to the front row. And but to those who are still joining, then we'll welcome you when you arrive. But to everybody else that's already on board, then let me just begin by thanking you for taking the time out of your day to be present with us this morning. It really is great to see so many of our clients and our business friends joining us for this presentation. As the normal in these events, they're quite tight for time, both in terms of the presentation and the delivery. So in terms of questions and answers, in Zoom, as you probably all know, there is a Q&A option. It's anonymous, but if you want to post a question using that, unfortunately, the time means we won't have an opportunity to respond while the presentation's in progress, but feel free to do so, and we'll certainly share any responses to your questions using all of our usual online forums. Of course, you're also entitled to email and contact us after the presentation, speak to either Alan or myself, or indeed the partners that look after your affairs. We're always delighted to receive your questions. This morning, in terms of the presentation, I thought it was helpful to put the budget into some kind of economic context. You may not have heard of James Carville, but you'll have certainly heard of the expression, it's the economy stupid. James Carville was actually an advisor to the Clinton campaign, trying to unseat Bush in the 1992 presidential campaign. And that was one of the mantras that everybody out on the doorsteps were to be told, it's the economy stupid. And and it's true that for chancellors, sometimes it's better to be a lucky chancellor than an unlucky chancellor. You could argue that our current chancellor was the unluckiest chancellor in history to become chancellor just as the pandemic broke out, or the luckiest chancellor in history to be the person that's probably spent more money on the economy than anybody else. But history will then ultimately determine just how lucky the chancellor was. But on Wednesday, the budget delivered what he called a tax, spend and save budget. And ironically, the improved official forecast gave him about a £35 billion annual windfall of revenue on top of the £36 billion of tax rises that he's announced in the run-up to this budget. He had the option of what to do with this unexpected windfall of additional revenue. He could have chosen to improve our UK public finances or spend more in public services. And as he set out the government's priorities, he actually, having spent so much of his time fighting the coronavirus crisis, he said his third budget would begin the work of preparing for a new economy post-COVID. This is to be a UK economy based on higher wages, higher skills and rising productivity. In some respects, the budget was quite hard to follow because of so many announcements that were made in advance. In fact, one commentator said that this budget had more leaks than a Welsh rugby match. But it's certainly true that even the Speaker of the House of Commons was a bit cheesed off at the number of pre-budget announcements and presentations that were made, and he wasn't happy at that. But to understand the background to the Chancellor's presentation, this is the movement in the GDP. And as you can see quite clearly, the massive dip that took place in March 2020. But since then, the OBR, which produces these statistics, has been upgrading its economic growth forecast quite significantly as the year gone on, as the impact of the COVID vaccine has had on the ability of the UK economy to recover. And in fact, at one point, they were thinking that the UK GDP would rise by 4% in 2021. It's now expected to be 6.5%. And much of that does relate to the success of the UK vaccine programme. And this growth will allow the economy to get back to its pre-pandemic level, hopefully in the first quarter of 2022, much earlier than thought. And some commentators think it might even be as early as Christmas. That would be a good Christmas present. There is, however, the underlying spectre, which you hear a lot of people talk about, is the spectre of inflation. As you know, the Bank of England is charged with controlling inflation and has set a target of inflation at 2%. Over the winter, the OBR now expects inflation will peak at 4.4%, mainly, they think, due to higher utility prices and petrol. This will hit living standards, with real household disposable income reaching pre-pandemic levels, could be even latest 2023 before we see that return. But the actual OBR thinks some inflation will be good for the Treasury, because it raises wages, and much of the additional revenues forecast over the next year or two coming to the budget are actually driven by that wage increases. The OBR expects the cash economy to be 5% larger in 2025 than it forecast even as recently as just March, as households begin to return to spending, and the potential increase in unemployment that was expected has not happened. That also makes an enormous difference to the outlook for borrowing. Borrowing was expected to be 234 billion as recently as March. Now it's expected to peak at 183 billion. So well below the forecast. So to some extent, the Chancellor is getting the benefit of the windfall gain brought about by the successful COVID vaccine, and maybe even just the robustness of the UK economy to stand by and survive the impact of COVID. The conclusion now that Sunak had a huge windfall from this higher GDP, but has chosen not to roll back his previous plans to increase corporation tax and national insurance, but instead deal with it in form of expenditure. So those were the kind of indications in the economic forecast of the OBR. But what's also becoming clear is that this improvement is not being spread evenly throughout the UK economy. And it may well be we are going to see two economies running in parallel. And maybe as well as balancing the books with his taxation system, the Chancellor also needs to have a strategy that will deliver the recovery for everyone that he maintains. So I'd now like to turn to some of the tax changes in the budget. As usual, I'll be looking at corporation tax, national insurance, but I'll begin, as I usually do, with a summary of the changes in the area of personal taxation. Personal taxation always begins with the personal allowance. The personal allowance of 12,570 has actually been unchanged for a number of years now, and as in previous years' announcements, that allowance is going to be frozen until 2026. And the freezing of the personal allowance, ironically, is one of the Chancellor's biggest tax-generating source of revenue, because as wages go up and living wages go up, then the freezing of the personal allowance, when you look at the OBR statistics, this is one of the biggest contributors to the Chancellor's war chest, and maybe a war chest that he's keeping back for the next election. But that's frozen until 2026. And Alan Mitchell later on in his presentation will talk about this concept known as fiscal drag, the impact of just freezing allowances. But in simple terms, it means just more money flows into the Chancellor. So the personal allowance that those who earn below £100,000 in the UK have a 12,570 personal allowance. The personal tax rates for the rest of the UK are being frozen as well, again until 2026. So again, freezing those limits means that people become higher rate taxpayers earlier, just purely because of wage increases, which I say is a frozen amount. Now, of course, the UK government can set the personal allowance, but the Scottish government has got control over the rates of taxes and the bandwidths. And while the UK has only got the smaller number of bandwidths of 3, and the Scottish government has got 5 bands: a starter rate at 19, a basic rate of 20, an intermediate rate of 21, a higher rate of 41, and the top rate of 46%, which is when people earn over 150,000. And so you'll see that the impact of that manifests itself in the rates of marginal income tax that Scottish taxpayers can have. So you'll see that with the tax rates I've just described, 21 through the various thresholds I've got there, and the national insurance. Now, this is for the current year. There's more in national insurance to come later. But you'll see there are some quite significant marginal rates of tax in the current tax year, marginal rates that will rise further, in the year ahead. And what does that mean, the difference between a Scottish taxpayer and a taxpayer in the rest of the UK? Well, if you've got earned income of just 50,270, with those higher rates and lower bandwidths, then your tax liability in Scotland will be £1,550 more in tax than those who live in the rest of the UK. And if you're just below the really highest level at the top rate of tax, then that increase of 1,550 becomes 2,673. But bear in mind that investment income, so that could be from dividends and so on, and bank interest, if that's your only source of income, then you pay the exact same rate of tax as the rest of the UK. Dividends has been targeted by the Chancellor in various budgets in the past, making them less attractive to people paying themselves dividends in their companies as opposed to paying salaries. The 2,000 allowance that everybody's got of not having to pay any tax on dividends in the first 2,000 remains unchanged. And for the tax year we're in just now, if you're a basic rate taxpayer, then the dividend rate is 7.5%. You're a higher rate taxpayer, it goes up to 32.5%. And if you're up at the highest rates of tax for those earning over 150,000, then the tax rate in dividends is 38.1%. But as the much heralded announcement, both in national insurance, but also in the rate of tax on dividends, those rates are going up by 1.25% on the 6th of April 2022. So those rates I've just referred to previously then all got by 1.25% to 8.75%, 33.75%, and for the higher tax rate payers, 39.35%. So we've often asked by clients regularly, when it's their own company and they have the option of paying themselves salaries or dividends, then what will the impact be on tax planning opportunities? So again, do I remunerate myself by a dividend, or do I do so by salary? Like most things in tax, there is not one size fits all, but clearly that is an option. Although it was with some degree of irony that I heard many people complaining during COVID that because in their companies they had elected to pay themselves only dividends and not salary, were most disappointed they didn't qualify for any of the furlough grants because their salaries were so small. And I had at least one commentator say rather wryly that ironic that those people who opted to take the dividends to pay less money into the tax exchequer then complained that the tax exchequer didn't give them any money back when the furlough grants were being handed out. But that's, you can decide for yourself if that was just unfortunate or just the luck of the draw. We also have a lot of people over recent years looking at, instead of paying themselves a salary, are opting instead to take a pension contribution. And with the increase in national insurance rates, we actually suspect that we're going to see an increase in clients approaching us about if they've got the opportunity to waive a salary and instead take a pension contribution, that may be seen to be a very attractive alternative to extra cash in your hand. Of course, you realise if you take a pension contribution instead, the thing you lack is cash. Okay, the much vaunted changes to national insurance were also announced well in advance, of the budget, although at least they were announced in the House of Commons, so the Speaker of the House wasn't quite as upset. But clearly, the biggest impact we're going to see there is next April, then there's going to be a 1.25% rise in national insurance. And that's going to be borne right across the board. So whether you're an employee, your rate's going to go up by 1.25%. If you're an employer, it will go up by 1.25%. If you're self-employed, it goes up by 1.25%. And then a bit of a curveball that this 1.25% will also apply to working pensioners. And most chancellors are always quite happy to steal MD Elsie's thunder. And so although in the first year of this 1.25% it will just be described as national insurance, the following tax year they're going to rebrand it. This 1.25% will be known as the Health and Social Care Levy. And I'm sure some political parties out there in the past have always maintained we'll put a penny in tax to pay for the National Health Service. So the only thing the Chancellor did differently was, one, change it to 1.25% and change its name and took all the credit for it. But I say Chancellors are not averse to doing that in the past, and I'm sure they'll not be averse to doing it in the future. But I did mention these changes to the rates. So you'll see then the rates on that table there, that the 12% will become 13.25%. But so that the Chancellor the following year in 23-24 can call it now just ordinary national insurance, the rates go back down to 12 and 2%. And I say this 1.25%. And I suspect most of us will know that once something comes in and it's called the Health and Social Care Levy, it's easy for the Chancellor just to leave that part, because which Chancellor wants to be the one that says, I am taking away this levy, which is purely to help out health and social care. So I suspect that there might be in for the long term. Did touch upon this earlier there about this impacting working pensioners, and you can see this from a number of different angles. First of all, is it sad for a country that we're now actually seeing more and more people in the UK of above state pension still in employment? Is that a negative thing? or is actually the ability of people in retirement age still to be perfectly fit and able to go out and continue to work, that's a good thing, because people are living longer and are much healthier. I don't comment on the merits and demerits of it, but it is a definite change in policy, because at the moment, pensioners, once they get to state pension age, do not pay any national insurance. The employer company still pays the 13.8%, but the individual pays no national insurance. And I say that employer's rate of 13.8 will become 15.05 next year. Likewise, the self-employed used to be when they reach state pension age, they stop paying their class 4 national insurance contribution. But from next April, there'll be a 1.25% extra national insurance for the first time. And then the year after that, this will now apply even to working pensioners. And in fact, as I've said, there are even rumours that perhaps the current age limits for nationals might be removed altogether, and simply say if you're in your 60s, 70s, beyond, and you're still working, well, in that case, you can still continue to pay national insurance like everybody else. Whether that happens is debatable. For those who are employers out there, there is still a relief of the first £4,000 of your employer's NIC bill. But remember, not every employer gets that. It's only if your bill for NIC the previous year was under £100,000. And that 4,000 allowance has been unchanged since 2019-20. Often in previous budgets, I've spoken a lot about cars, and it's quite clear to see that we're still in a period of change. I say, obviously, with the COP summit taking place in Glasgow very soon, then the idea of a green lobby will only rise. Although actually, somewhat ironically, and has been commented on by many people, the Chancellor managed to get through the entire presentation of the budget with very, very limited references to the impact on environment or the impact of COP26. And at the beginning, strange enough, I did mention the slogan, "It's the economy, stupid." Couldn't get through this presentation without mentioning Greta Thunberg, who'll be at the conference. She famously, a couple of years ago, went onto a stage where a large sign had been put behind her saying, "It's the economy, stupid." And as a show of an example, got up a step ladder with a spray paint and sprayed out the word economy and replaced it with planet to then give the new catchphrase, "It's the planet, stupid." And maybe we'll be watching with some degree of interest on the outcomes of the COP26 climate conference and what impact that will have on all of us. In terms of the cars, though, I'll not go through all the benefits of having a company car, which is electric, and the rates. But in terms of the rates that you can claim on a car, these are unchanged. So if you've got your own car and you're providing, sorry, the company provides you the car and you're only, but not mileage, then these are the rates that you can claim. And you'll notice that you can also claim 4 pence per mile if you have your employer, the car you've got is an electric car, and you can get the 4 pence a mile, ironically, even if you charge your car on your employer's premises. So there's some degree of an interest in that one, that you can go to your own office, charge your car there, and then still charge 4 pence a mile for using the electricity that your employer put in your car. But that's not just related to if the company gives you the car. That also applies with if you opt yourself to go out and buy a car of your own and not have a company car, that these limits of being able to claim from your employer tax-free 45 pence a mile for the first 10,000 business miles, declining to 25 pence, then this is an allowance given to you for providing your car. It doesn't stipulate whether it's a small car. It doesn't stipulate whether it's a big car. It doesn't stipulate whether the car is diesel or petrol or electric. So for some people then, the option of an electric car, particularly if you do quite a lot of business miles that you can claim for an employer, may actually make the option of an electric car even more attractive. But whether that's what happens in practice, we will see. I did mention that some employers are now looking at installing charging facilities on their own premises for staff and even maybe clients and visitors to charge their cars. And if they do so, then there is no benefit in kind on having electric car charging at your office. And as I said already, no benefit in kind for members of your staff who get to use it. And you can claim capital allowances on installing of the charging stations, and that's been extended till 2023, 100% deduction. But you cannot claim that if you put the charging facilities in your employee's home. the benefit of having a company van has always been significantly greater than a company car. The tax on it has been much better. And indeed, many businesses in recent years have been encouraging their employees to have a company van rather than a company car. Many waking up to the fact that the van became almost an advert on wheels. But not only is there now an attraction to having a company van being a much lower benefit, but even a greater benefit if the van itself is an electric van. So again, if you've got a workforce out there and you can find small electric vans, then you've got the opportunity of an advertising campaign. You've got the opportunity of your employees benefiting from no tax charge to pay on it if it produces zero carbon emissions. So again, it'll be interesting to see if these macroeconomic policies of the government make a difference at the coalface. So that's really all I wanted to cover this morning on the question of cars and of vans. So the other area that I now wanted to move on to was to just touch on the changes announced in the area of corporation tax. Corporation tax is another of the relatively large tax takes that comes to the Chancellor. I'll say later in the presentation, Alan will share with you just exactly how much tax all the big tax revenue generators are. What was interesting was that the major UK economies got together and agreed that there should be a minimum rate of corporation tax across all the major developed countries. And that was really an attempt by the G7 to stop individual countries in order to attract inward investment, setting very low corporation tax rates. So there's now an across the board, but just as they announced a very low rate, of course, the UK government, due to COVID, went the opposite direction and announced changes to the UK rates and an upward. We were on track for a corporation tax rate downwards to as low as 17%. The brakes come on there, and therefore they froze it. Instead of going down to 17%, it went back up to 19%. And as was announced last year, that 19% rate is going to rise to 25% from the 1st of April 2023. There is a small exemption to the small companies in that the first £50,000 of profits remains at this rate of 19%. So those companies with profits above £250,000 will then have a 25% corporation tax charge. And as usual, when chancellors announce a low rate for category A and a high rate for category B, there's got to be something you do when you move between the 50 and the 250, and that's usually called some form of tapering relief. So there'll be a hybrid rate between the 50 to 250. But the headline rate, though, is for companies with profits above 250,000 from the 1st of April 2023, the headline rate of tax will go up from 19% to 25%. A lot of discussion has taken place in the last couple of years in the whole vexed question of research and development tax credit. And there were a number of quite interesting announcements made in this year's budget presentation. But the core element of R&D is broadly unchanged in that SMEs or small and medium enterprises, then they're able to claim this larger level of deduction over a profits of relevant R&D spend of 230% of any pound spent, which either creates reduces taxable profits, or if it creates a loss, then you can either utilise that loss by just carrying it forward, but if you want, you can sell effectively the loss back to the Chancellor and sell it back at the rate of 14.5%. And for many businesses, particularly those that are innovative and are investing significant sums in R&D, this SME payable credit of 14.5% is a very valuable cash flow assistance in the earlier years. Again, though, there are now some restrictions in place, and this was a restriction that was in at the start, then was removed and has now been brought back in again, which is to restrict the R&D tax credit to the amount of the company's POE NIC liability for the year. So companies that run with effectively no employees or nominal months. So now at the moment, if you want to claim the R&D tax credit, then there's a cap now on it at £20,000 plus 3 times your total POE and NIC liability for the year. The government looks very closely at the businesses who claim research and development tax credit, and when they did their analysis, they identified that the relief given in the previous tax year was 48 billion. That's a big number. But what they identified was that of the R&D carried out, almost half of it was carried out outside the UK, with 22 billion invested in the UK, and the remaining, obviously, 26 billion, carried out outside. So they've done two things, one which is good and one which we're really going to have to wait and see whether it is good. The first one, though, is extending the definition of what R&D is, that now covers cloud computing and data. So that was a previously excluded category. So that will widen the scope of eligibility for certain companies. But slightly more concerning is that for many companies, their R&D activities are carried out by in a country outside the UK, that will no longer be eligible. Now, whether that will have the desired effect, which is to encourage UK companies to bring their R&D activities back to the UK, only time will tell. But certainly there are some fairly substantial businesses who have got major R&D centres outside the UK, and it will be interesting to see what they do in response to that. When COVID hit, the Chancellor announced a raft of measures trying to help businesses to get through COVID. And one of the things was the Chancellor knew was there was an expectation that in the year to March 21, the first year after COVID, and probably in the year to March 2022, many companies were likely to suffer trading losses. And although the economy has performed much better than many expected, there are clearly some sectors for which that is still going to be true, particularly the hospitality, the airlines, and many others for whom the bounce back will be much slower to take effect. And therefore the Chancellor, knowing that there would likely to be companies with losses, gave some additional generous relief to what companies can do with those losses. Normally, if you've got a loss in 1 year, your only option is either to carry it forward to next year, or if you had a profit the year before, carry it back 1 year. So we now have a situation for those 2 years that instead of carrying the loss back over 1 year, you can carry it back up to 3 years. So if you've got a loss in 1 year, you can look back at the previous years. You have to use the oldest year first and then carry it forward. There is a limit of £2 million, but for the vast majority of companies in the UK, that will not be an issue. And also remember, that's not just limited companies. It also applies to sole traders and partnerships. So unincorporated businesses also get the benefit of that relief. Capital allowances is a major source of incentive to a business to why they would go ahead and spend money on new trucks, on new plants, or such like. And the annual investment allowance has been used by many companies to be able to set aside a significant amount of first-year expenditure. It was previously £200,000, and as a temporary measure, that was extended to £1 million, allowing businesses to incur capital expenditure of £1 million and set it all against tax. That was due to expire this December, on the 31st of December 21. But in this budget, it's been announced that that's going to be extended right through to March 23, which ironically also coincides with the date when the rate of corporation tax goes up to 25%. So that's when that date will end. So that's a big incentive to businesses now, particularly as the Chancellor is looking to businesses to spend their way out of COVID and encourage the recovery of the economy. Once you've got your annual investment allowance, then all other assets are either in the general pool and you can write down 18% a year, or if it was integral fixtures and fittings, so when you build a nursing home or you build an office, there were certain items of equipment inside the building that you can claim a tax relief of 6%. And both those two are unchanged. What also the Chancellor announced last year, though, was this concept of what's called a super deduction, right? And then so assets that would normally only get this 18% allowance, that if you spend £10,000 on a computer, that you can upgrade that by an extra 30% to 130% of the expenditure. So these are super deductions, yeah? And likewise, if it was in a qualifying building that you would normally only get the 6% allowance, then you can actually get 50% allowance. So those engaging in new buildings, new nursing homes and so on between now and March 2023, then a significant opportunity to ensure that expenditure is incurred prior to March 23 and qualify for the super deduction. But most things, that there are always some additional rules. Remember, unfortunately in this case, super deduction does only apply to companies. So this time it doesn't apply to sole traders, doesn't apply to partnership. The super deduction only to companies. It's got to be a new asset, not second hand, And if you sell the asset after you've bought it and claimed this relief, then when you sell it, then to avoid people taking advantage of the scheme, they will add 30% onto your taxable profits if you sell that asset. So I'm just going to end with a very simple example to show how combining losses and the new capital allowances and the super deduction scheme all come together can still produce a significant cash flow advantage to a company. So a simple example of a company with a year ended 31st March 22, it's got a taxable loss of £100,000, but in the current year, it also spends £250,000 on new qualifying plant and machinery. Then what it can now do is it takes its loss of £100,000. The capital allowances spend of £250,000 gets grossed up to £325,000 because of the super deduction rules. So we've now got a total loss of £425,000. And instead of only being able to carry that loss back 1 year, can actually look at their profits in 19, 20 and 21. And if they're able to use those, then they could get a repayment of £80,750 in corporation tax. One little thing to watch out for, though, and some people were already asking us about this, that if corporation tax rates are going to go up in 2023, if you've got a loss in 2022, if you carry it back, you'll only get tax relief at 19%, apology, at 19%, but if you carry it forward, you'll get relief at 25%. So there will be decisions to be made, and that will be a trade-off between cash flow and the certainty of the profit arising the following year. But clearly, all these things involve discussion with accountants and tax advisors to make sure that if there is a super deduction to be got, that you get it. If there's an opportunity to claim capital allowance, you do. And if there's opportunity to use losses well, that you indeed do exactly that. So that's really all the material that I've got for you this morning, and I'll be delighted now to hand over to Alan Mitchell, one of my partners, and he's going to be taking us through the other taxes. So thanks very much for joining us thus far, and I hope you find the second half enjoyable, and I'll get a chance to speak to you later. Thanks, Alan, over to you.
Thank you, Andrew, and welcome everybody. Thank you for joining us today. Before I start talking about what Rishi Sunak has said on Wednesday, I'd like to start off by sharing a quote from a previous Chancellor who was a giant of politics in his day. And he said, "No government can provide an economic miracle. An economic miracle depends upon people on the shop floor, in the boardrooms and in the sales offices, all working a bit harder and more effectively and efficiently than they've worked in the past." Now, you would look at that quote and say that could have sat very well in Rishi Sunak's budget, where the focus was on economic recovery, productivity improvement, and also personal responsibility, where he said that UK government could only do so much in terms of seeking economic recovery. So it may be a surprise for you to find out that these words actually came from one Dennis Healey, a giant of the Labour Party, who was Chancellor in the 1970s as Britain grappled with skyrocketing inflation, an energy crisis, and rubbish piling up in the streets. Politicians may come and go, but it seems that as a country we continue to face the same challenges as generations move on. Anyway, moving on to what Rishi had to say. What was he going to do in terms of balancing the budget this year? Well, if we can first look at where does the money come from, and this is the challenge any Chancellor faces when they're looking to balance up an economic budget. There are only three main taxes that contribute significant amounts. Income tax, national insurance and VAT cover 57% of the total tax take in any 1 year. So Rishi's options in terms of raising additional funds were limited. Firstly, because he had a manifesto that said he would not raise income tax, national insurance or VAT rates in the life of his parliament. So the other option would be to borrow more money. But as Andrew indicated previously, borrowing is up to the maximum highest level that we've had for many years. So those two levers available to him were fairly limited. So what has he done? Well, he has turned to another former Labour Chancellor to follow his actions. And that Chancellor was one Gordon Brown. And Gordon was often accused of taxing by stealth, i.e. he didn't raise income tax rates or national insurance rates or VAT rates, but he froze allowances across the board, where the effect of inflation would mean that additional tax revenues would be collected. And as we can see from this slide, if we look at this purely from an income tax and national insurance point of view, by freezing these personal allowance, the basic rate bands and the national insurance levels that Andrew's described previously, UK Treasury will collect over the next 4 years an extra £19 billion of revenue. But Rishi hasn't stopped just at income tax and national insurance. As we'll see later, he has frozen capital gains tax allowances and thresholds, personal pension allowances and thresholds, inheritance tax, and even VAT thresholds will have an impact, which means that over the next 4 years, UK government will collect an extra £21 billion of money by effectively doing nothing. It's a bit unfair to say, though, that the government have done nothing. We've obviously had unprecedented business support over the last 18 months between bounce back loans, Sybil's loans, the furlough scheme, rates relief, and various grants that businesses have been able to enjoy. But that's all now coming to an end, and we're moving into the kind of repayment phase in terms of the loans. But there are still some rates reliefs that have been introduced this year. And for England and Wales, who currently receive 100% business rates relief up to 5th April 2022 for retail, hospitality and leisure industry properties, they have extended this relief to an extra 50% rates relief for the coming year with a cap of £110,000. Business rates is a devolved matter. So in Scotland, like England and Wales, we currently are enjoying 100% non-domestic rates relief for the sectors that we talked about, but that ends on the 1st of April 2022. So we'll have to wait and see what happens in the Scottish budget, which is scheduled for the 9th of December this year, to see whether Kate Forbes can match Rishi Sunak in terms of that level of support for those industries. I'm sure for most of you, you would have thought you would never hear that word furlough ever again. Obviously, the furlough scheme ended at the end of September this year, but I'm afraid Inland Revenue are being challenged just now to try and recover what they consider to be over £7 billion worth of furlough claims and self-employed income support scheme grants, which they view have either been fraudulently or erroneously claimed over the last 18 months. And they're doing this by appointing a squad of inspectors to review claims that have been submitted. And they're starting this process off by issuing what we're calling nudge letters. So these are letters, and we've received 1 or 2 into this office for clients already, where their revenue are asking the client to consider whether they believe that their claims for either of these grants have been correctly prepared. It's a very open letter. Some would view it as a phishing letter. It will not tell you that they believe that you've made mistakes. They're just asking you to consider whether you're happy that your claims were correct. Our advice to you is not to ignore these letters, is to pick them up and have a good look at your claims, make sure you're comfortable and respond to the revenue on those. If you ignore them, then if there is an inquiry that you receive into these areas and it turns out that there are errors that have arisen, then the level of penalties that you're likely to incur will be particularly strong, up to 100% of the overclaimed grants that are there. Right, if we can move on to the first of the direct taxes. In Scotland, we've got land and buildings transaction tax, and in the rest of the UK, SDLT. And this is a classic case of fiscal drag. It's a devolved tax for us in Scotland here. So Holyrood is in charge of setting the rates and the bands that this tax applies to. Rishi Sunak has determined that there will be no changes to the stamp duty land tax in the rest of the UK. We will have to wait and see whether Kate Forbes follows suit in that. But the reality is, in the property market, the house prices have grown by between 10 and 11% in the last year and anticipated to grow by another 5%. If there are no changes to these thresholds and no changes to these rates, then the government will collect more tax. A classic case of fiscal drag. But in Scotland, again, we'll have to wait until the 9th of December to determine whether there will be any changes to this. The other direct tax is VAT, and again, we saw very little change here in the budget. In terms of the rate of tax, that has stayed steady at 20%. Thresholds have remained at 85,000 and the deregistration thresholds at 83,000. Even just holding the registration threshold at 85,000 and not increasing it by inflation is determined that it will increase the Treasury's take from VAT by £480 million a year. And obviously we've got price inflation across the board, particularly in the energy sector, where there is a flat rate of 5% VAT on that sector. So by prices going up, the government is going to collect more VAT without actually making any changes at all. So another classic case of fiscal drag. The final point in terms of VAT was an extension to the hospitality benefit rate for that sector. And if you remember, back in July 2020, we had the Eat Out to Help Out, and we also had a reduction in the rate of VAT for this sector, which dropped from 20% down to 5%. In October this year, that rate has moved up from 5 to 12.5%, and then from April next year, we will see that rate return to the full 20% VAT. So if you're in that sector and you've been enjoying that reduced rate of VAT to help you out during this difficult time, make sure that from October you change your VAT rates to 12.5% and be aware of the change next April. Finally, on VAT, we've got a new penalty regime that's coming along from April next year. And rather than the surcharge system that operates just now, where you effectively have 3 strikes of late returns before you start to incur penalties and surcharges, there's a new points-based system, and points here don't make prizes, points make financial penalties. So once you reach the certain number of points that are required because you've submitted returns late or paid returns late, then you will have a fixed penalty of £200 for every late return thereafter. And those points will stay with you until you've got a period of clear compliant submission of returns. Just like your speeding fines, if you've got any, these points will expire after 2 years and disappear at that stage. So if you're looking to have a clear license on VAT, so to speak, then you need to make sure that you have a clean bill of health for over 2 years to be able to exempt yourself from penalties. Moving now to Making Tax Digital, and for most of you, Making Tax Digital will have been centering around VAT return submissions for the last few years. This is about to change and be extended to income tax returns. And for individuals who have a requirement to submit a self-assessment tax return, this will now kick in terms of MTD from April 2024, so a good couple of years away yet, but it's starting to get closer, and we need to think about the implementation of this. For partnerships, it's been delayed a further year until 2025. Who does it apply to? Well, anybody who is self-employed or has letting income where their income is in excess of £10,000. That's £10,000 in total, not individually from those sources. And if you fall into this category, you've got some new obligations in terms of how you report your income to the Inland Revenue. Firstly, you must keep your records in a digital format. So that paper cash book is no longer going to be suitable. It must be kept either in a spreadsheet or accounting records. And secondly, rather than just reporting this income once a year through your self-assessment tax return, there's now going to be a requirement for you to make quarterly submissions online to the Inland Revenue of your self-employed income or your letting income. Why quarterly? Well, the revenue say that they just want to see the level of income that is developing over a period. But if you look at the guidance, they're now encouraging people that if you want to, you can pay your tax quarterly rather than at the end of the year. So I think that gives us a clear indication of the direction of travel here in terms of making tax digital, that there will come a time where HMRC will seek for us to pay our tax as we go, similar to the PAYE system. The quarterly returns are prepared on these quarter dates with a 1 month window to be able to submit the returns. You can make an election to move it to a month-end quarter rather than the 5th of the month, and that will be available once the system is up and running. So once you've submitted your quarterly returns, what do you then have to do? Well, the next stage is you need to submit an end of period statement, EOPS, which will be your final account of your self-employed income or your letting income for the year. And this return statement is required to include a total of the 4 quarters that you've submitted, together with details of any accounting adjustments that you've made to get to the final position at the end of the year. And this return must be completed by the 31st of January after the end of the tax year. So similar to the deadlines for your self-assessment tax return. And then finally, you're also required to make a final declaration online, which will replace the self-assessment tax return. This final declaration will obviously encompass your self-employed income and your letting income if you have any, but it will also include any other personal income like bank interest, dividend income, etc., and any claims for reliefs that you're making. And again, this final declaration must be submitted by the 31st of January following the end of the tax year. So let's look at an example here of a Mr. Smith who has a turnover of £8,000 from his self-employed income and rental profits of £5,000. Because he exceeds the £10,000 threshold there, he is required to engage with HMRC through Making Tax Digital. So he's going to have to make 4 quarterly reports for his self-assessment and 4 quarterly reports for his rental income. So that's 8 submissions he needs to make in year. He then needs to complete his end of period statement for both of those sources of income, self-employment and rental income, and then a final declaration to the Inland Revenue before the 31st of January following the end of the tax year. So we now have a system that will require a taxpayer or an agent, because there'll be an agent portal that we're able to do this on your behalf. We've now got a system that requires 11 submissions to the Inland Revenue, compared to a system today that only requires 1 submission, a self-assessment tax return each year. Not sure if that sounds like progress, but I think the key thing here is that the Revenue want oversight of the levels of income that we're reporting each year, and also to move to a system where we are likely to be paying taxes sooner and in year, similar to the employment tax system. At the same time, for those who are self-employed, either sole traders or partnerships, we've got a new system called Basis Period Reform that is being introduced. So basically, the sole traders and partnerships of you out there will realise that you are taxed in a tax year based upon the accounts that end in that year. So if you have a year end is 31st of March, then your accounting year and your tax year align. But for many businesses, they do not have that year end. They may have a year end of, say, the 31st of December, as we show here. And for a particular tax year, if you've got a December year end, then you are assessed to profits in that tax year based on that December year-end set of accounts. But the revenue want to see the alignment of the tax and the accounting years. So from 2023, we move into a transitional phase where the alignment takes place. And how that works is that if we take the example of the December year-end taxpayer, in 2023-24, they will be taxable on the 12 months to 31st of December 23 profits, plus 3/12 of the profits for the year ended 31st December 24, effectively 15 months worth of profits in that year. But the excess profits that arise in that year, the revenue are telling us can be spread over a 5-year period. So if we have a look at this example here, and this looks at probably the most extreme case of a client who's got an accounting year of the 30th of April, and they've got profits in the 23 year of £55,000, and in the following year of £66,000. Then in the transition year of 2023-24, their profit figure that they're going to be assessed the tax on will be the full year to 30th April 23, the 55,000, plus 11/12 of the profits to 30th April 2024, an additional 60,500. And then there'll be a reduction for what are called overlap profits. Now, these are profits that were subject to double taxation when you started up in business. So in this case, in this example, we've worked out that those profits were £20,000. So effectively, from a normal year where this individual would have been taxed on £55,000, in 2023-24, they will be subject to tax on £95,500, an additional £40,500. But as I said earlier, there are transitional provisions that allow that extra £40,500 to be spread over 5 years. So effectively, over the next 5 years, this taxpayer will have an extra £8,100 of profits added to their in-year profits that are earned in that year. So clearly this is going to have a big impact potentially on cash flow for some clients, and we really need to think about and work with you to establish what's the best way to tackle this basis period reform. Maybe it's important that you possibly change your rent sooner than 2023-24 to take advantage of maybe lower profits during a COVID period, or possibly look at what expenditure you can claim on capital allowances or other reliefs during this transitional period that will make sure that you can limit the impact of tax during this basis period reform. Key there is to speak to us so that we can start to review what impact this may have on you in the coming years. Okay, moving on to pensions. It's always an area which is subject to debate and in particular whether certain rates of allowances and reliefs should be restricted. But once more, no changes here. We still have the annual allowance of £40,000, the maximum amount that can be paid in by an individual into the pension. And we have a lifetime allowance cap, which has been frozen last year and will remain frozen until April 2026. It's anticipated by freezing this lifetime allowance, Treasury will increase their tax take by over £1 billion over the next few years. Similarly, looking at investments, I'm afraid there was no change there either. We still have the ISA allowance of £20,000 per year per individual, with a junior ISA allowance of £9,000. So no inflationary increases on these amounts that would impact upon individuals' ability to pay extra into tax-efficient investments. Similarly, capital gains, very little change there. We still have the annual exemption held frozen at £12,300, and the rates of tax remain the same, with a differential there for residential property disposals versus all other disposals. Good to see business asset disposal relief survived the budget. There was much talk about this getting pulled. It used to be called Entrepreneurs Relief, changed its name a couple of years ago when it was reduced to £1 million. But it's still surviving there, so still an opportunity there to benefit from a generous rate of tax as low as 10% on capital gains. It has been an area that has been subject to review by the Office of Tax Simplification, and there has been concerns that there may be a wholesale change to capital gains tax in the future. There was one welcome change though, and this was to do with reporting of capital gains on residential property disposals. Last year there was a change to the reporting of this type of disposal, where within 30 days you had to report a gain to the revenue and pay the tax due on the disposal of that property. It's been recognised by the revenue that that 30-day time scale is really unworkable, and they have increased the time limit from immediate effect from 30 days to 60 days. So you now have 60 days from the date of disposal of the property to report the gain on that property and pay the tax. Pretty much finally looking at the final tax there of inheritance tax, again one that was subject to much debate as to whether there should be changes, but again Chancellor has frozen everything there until April 2026. So we still have a nil rate band of £325,000, a death rate at 40%, and we still have a residential nil rate band if you own a residential property at death and you pass it on to your surviving children. Then there's an additional allowance of up to £175,000 there. But again, by freezing these allowances, Treasury will again benefit by over £1 billion over the next 4 years, again by doing nothing. So what does this leave us with a frozen set of reliefs and allowances as we move through the budgets in the next couple of years? Sunak has obviously indicated that he wants to be able to cut taxes as he moves towards an election, which is likely to be in 2024-25, and therefore it's likely to be that we could well find that there's very little movement in tax over the remaining period, assuming he finds that the economy behaves itself and recovers. But at the same time, as I said earlier, the Office of Tax Simplification have indicated that capital gains tax and inheritance tax are effectively no longer fit for purpose. So these areas, these two taxes are under the scrutiny just now. But at the same time, if we go back to my very first slide, they are not big tax collectors, and therefore it's unlikely that the Chancellor may focus in on those as a means to raise taxes. But he's not above tinkering at the edges of tax, as we've seen in this budget. He's made wholesale changes to alcohol duty, tonnage tax, and air passenger duty. So it could be over the next couple of years he does turn his attention to capital gains tax and inheritance tax. That's everything I would like to cover today. Halloween is nearly upon us, and certainly Rishi Sunak has shown us some of the tricks that he has up his sleeve in terms of using fiscal drag. However, I think his treat bag was empty after the COVID support he's given us all. So no treats at Halloween this year from this budget. As Andrew indicated, if you have any questions, please feel free to post these through the Q&A or email Andrew or I or any of the other partners at Thomson Cooper, and we will endeavour to get back to you with questions on these. Before I go, can I say one other thing? Remember the 5th of November. Next Friday, we have another webinar. Next Friday, we have Professor Paul McGee, aka Sumo Guy, who will be hosting a seminar for us, who will be telling us how to adapt and thrive in this current post-pandemic world. So if you're not already signed up for this, please visit our website, go to the events page on the website and follow the link there and register. It's sure to be an interesting and entertaining webinar.